Hello, everybody, and welcome to the Crypto Hipster Podcast. This is your host, the Crypto Hipster, Jamil Hassan, where I bring you founders, entrepreneurs, executives, thought leaders, artists, musicians, you name it, all over the world in crypto and blockchain. And today and the summer season, I am bringing to you a new compilation episode. Last year, from seasons 1, 2, and 3, I brought you the Crypto Hipsters Chronicles. And now, from season 4 and 5, without further ado, I bring you the Crypto Hipsters Mysticals. And what that is, what it was last year, and what it is this year, it's a compilation. It's a compilation of 3 or 4 podcasts together as like a montage. And on a certain topic or area of interest in crypto and blockchain, pulling from my podcasts. And now, as we're heading into the summer of 2023, I bring to you the Crypto Hipsters Mysticals. And there's going to be 22 or 23 or 24 around their episodes. And I look forward to you looking forward to it. So thank you very much for tuning in. Thank you for enjoying my podcasts. And this is going to be a summer treat for everybody. So please sit back, enjoy, and let me know your thoughts. This is Crypto Hipsters Mysticals, episode 7, a spot check inventory on crypto market predictions at the 2023 midway point. This compilation of podcasts combines 3 clips from 3 different podcasts. The first is Denis Veisillari, who is the project manager at Napcat. Second, David Schwartz, head of strategic partnerships at the Litecoin Foundation. And third is Jeff Dorman, the chief investment officer at ARCA. Enjoy. So all along in the years I've been in crypto, we talk about the collective wisdom of the crowd, right? But not everybody's tapping into the collective wisdom of the crowd. So how have we not done that yet for the ones who haven't done it? And how could they do it better? And then how would that make a difference?
Right. Very good question, actually. So I do think that slowly as a collective, we are becoming better as a society. However, internet is taking a lot of our attention, and usually this attention means focus, or actually, I'm not so sure how to how to respond to that so well, but communities, I would say, work well simply because they connect the individual, or actually the individuals connect together. And each individual can have different likings and preferences, and this is totally acceptable. And those preferences slowly accumulate. And let's say, for example, a lot of people like Doge, or a lot of people like to oppose a narrative, then usually they will have an impact. And we see that, for example, with Wall Street bets, where everyone was shorting, the community just decided to go against the trend, and they literally liquidated so many hedge funds just because, degenerates, let's put it like that, as known in crypto.
Let's make it more crypto-centric then, because Wall Street bets is, I think GameStop, I think AMC, I think stocks. Stocks are not crypto. What is crypto? Celsius Network's crypto. Other companies are bankrupt that had a run on them of crypto. And buyers now, the institutional buyers coming in, are less community-centric and more money-centric. Why do you think that these community-centric people are going to fall off if the only focus is on the money?
I didn't get the question. What?
If the focus is on more on finance and less on the community, why do you think the community is going to fall apart or fall to or leave?
I don't think the community will leave. I think actually the community is empowered by, let's say, a few influencers, or if the narrative is good, if the vibe is good, people will stay. Even if, let's say, for example, a financial model is not so well. It's not so well established. Like, people might stay just because they like it, they like the community and everything, and slowly they will start contributing. The product will become better, and essentially, even a bad product essentially has a good chance if it's backed by a good community. And my point on that, I guess, is that uh, you can have the best software, or you can have like $5 billion to power up a startup. If that startup doesn't have community, doesn't have people that actually love the product, or they feel fit in that community, this startup probably will fail. So yeah, I think that's very important, frankly speaking. And crypto is kind of doing that. Like, it's bringing finance in a more community-oriented way.
So let's talk about societal benefits. Long-term societal benefits of connecting communities seems now to be more important than ever before, right? Why do you think that's true?
Well, I think it's mainly because the internet. So we have a lot of there are a lot of small groups, a lot of channels, a lot of cool people that actually can show their face in a global scale. You can literally be living in a very small village that has 10 inhabitants. However, due to internet, you can create your own community online, and you can have like 10,000 members joining that community. And it's not necessarily a reason for you. You don't have a reason per se to profit out of a community. You can have a community just to have fun, to hang out, to to spend your time, exchange ideas, and of course, like trading resources, or trading opportunities.
There's a contagion, there's a bear market right now, but wait a second. You were here in 2018, and I was here in 2018, and it looks really similar, leading up to August, when the halving was then in 2019, and the halving will occur in 2023. So what do you see as far as navigating this contagion and the upcoming halving for Litecoin's outlook?
Well, I think from the contagion perspective, if you watch price, right, it fared really well versus a lot of other assets out there. And I think there's a couple of reasons for that. One is probably the fact that it's not as much of a speculative asset as a lot of other ones are out there. You get a lot of people who are actually just buying and holding. They're not necessarily trading it so much, or they're using it like it's meant to be used. And so it's sort of normal day stuff, right? And so if you see other cryptos, they just got slashed during this contagion. And even Bitcoin, because technically, I mean, if you think about it, a lot of that was just paper Bitcoin floating around. And so you saw it drop for a while there, and now it's recovering because everybody's pulling their Bitcoin off of these exchanges. But a lot of these exchanges technically didn't have that much Litecoin on their platforms to begin with, right? Like storing it, like actually custodying it. So it wasn't affected the same way, and price actually went up because people were realizing some of these crazy tokens and whatever else don't really have much behind them, and so they were taking that money and putting it back into whatever you would call, blue chip or more conservative or more realistic liquid assets like Bitcoin and Litecoin and maybe Ethereum or whatever. But so it didn't get affected as much, and I anticipate, just like any other halving that's happened with Litecoin, as we get closer to that next year, you'll see a spike in price because the inflation gets cut in half. And if you go back and look at 19, the hash rate goes spiking, the price spikes, usage spikes, everything goes up. And then for a time after that, it's, it cools back down again. But that halving is a big deal. And then usually you don't see realization of that until probably anywhere from a year to 2 years later, where the price actually reflects that more, right? So you'll see that burp in price, and I don't anticipate that not happening. Even if like there's some black swan event, macroeconomic type stuff, you're probably still going to see it in some respect. May not be as amplified, but you'll see one. So when does that start? I think there's people starting to accumulate now, and that's probably the other part of why you didn't see as much of a drop, is because people realize you get in early than what is considered early. Get in earlier than what's considered early, and that's what people are trying to do now with that. So it was probably good timing.
Yeah. I started around Christmas in 2018. I had a couple heart attacks, and I said I used Litecoin as a way to recover. Saying it's a way to look forward to it, and then the price did go up eventually, over the next 8 months. But you said the word there. You said hash rate, right?
Yeah.
So one of the things we look at in Litecoin is hash rate. So how's the hash rate doing?
It's great. It's been consistently at or above 600 now, which is, basically highs. Those are all-time highs. So I think the last time it was around there was around that same time we were just talking about. And so now that becomes the norm, right? And so I would anticipate the hash rate when you get closer to that halving is just going to be like nothing we've seen yet. So I'm very happy with the hash rate. It shows a lot of security. What's funny is I've seen a lot of Bitcoiners lately on Twitter. They try and compare script hash rate to, the SHA-256, which is what Bitcoin and others on that hashing algorithm use. And it's so comical because they're so different. It's like literally like comparing apples to oranges. There's no comparison. I mean, everything about them is different. So for Litecoin to dominate 98% of the script hash rate is a big deal. And for somebody to try and compare the two as if one's dying off and the other is accelerating is really comical to me.
Let's talk about your 2023 predictions, because a lot of people made predictions in 2022 and no one predicted the CeFi implosion. So you have some predictions for 2023. And the first question I have is about your predictions is, how will digital assets as an asset class decouple from traditional markets and remain uncorrelated going forward?
Yeah, and we've been running these outlook pieces for a few years, and sometimes we're right, sometimes we're wrong, as you mentioned. I don't think very many people called the implosions of so many of the once stalwart companies of digital assets last year. But some of the writing was on the wall with regard to how much just leverage there was across the system, and certainly some companies that in our opinion weren't necessarily the most kosher. But yeah, I mean 2022 was definitely a certainly outside the norm that we were expecting. In terms of 2023, though, I think it'll be quite different, right? For obvious reasons. One is that a lot of the bad actors in the space have either organically been cleaned up through bankruptcy or now through regulatory actions. But one of the things I think is probably most interesting is that a lot of people weren't paying attention to blockchain until really the last 18 months. And they didn't see that for most of blockchain and digital assets existence, that this was a pretty uncorrelated asset class. That what happened in the traditional world of debt and equities and real estate really had no bearing on what ultimately happened to the prices of these different digital assets. What happened in the last 12 months, or really last 14 months, right, starting in November 2021, was that correlation became really high, because ultimately the path that central banks around the world took on that inflation created a pretty strong negative wealth effect that affected everything, right? I mean, last year was one of the first was the first year ever that both fixed income and equities were down more than 10% in the same year. And obviously, real estate is starting to get hit, and then the digital asset market down 60% plus, depending on where you look. So the common narrative now is that this is just another asset class that is going to be highly correlated to the rest of the market, and therefore It's really just a higher beta exposure to the same things. And that's what I would really challenge, because I think digital assets have historically been uncorrelated for a reason and will continue to be uncorrelated going forward here, because you really have totally different drivers of value. And what I mean by that is, you look at a traditional bond, like a corporate bond, or you look at the stock of a company, and it is incredibly impacted by rates and by cash flows. Meaning, the higher interest rates obviously will negatively impact a discounted cash flow model in terms of the terminal value of those cash flows. And also, if you have lower demand for goods and services, and ultimately you have lower cash flows, which reduces the value of a stock, and also obviously limits the ability to service your debt. But what's more interesting about digital assets is, again, most of them outside of Bitcoin, I put Bitcoin in a totally different class, because Bitcoin really is more of a belief or a religion than it is a financial instrument. But the other tokens, for the most part, again, are these hybrid instruments. And the best way to think about what I mean by a hybrid instrument is, take Amazon, for example. You have Amazon shares, which represent the revenues and the cash flows of Amazon as a business, right? The better Amazon does as a business, the more those revenues and cash flows increase, the more money you make as a shareholder. But now you have now you have Amazon Prime, and Amazon Prime is really more of the loyalty or the utility value of Amazon the business, right? It gives you free shipping, it gives you movies, it gives you music, it gives you Whole Foods discounts, right? You get all these different value drivers from that. You can very easily be an Amazon shareholder without being an Amazon Prime member, and vice versa. You can be a Prime member without being a shareholder. So as a result, the two different values, which are not the same, accrue differently to different people in the Amazon ecosystem, right? Customers, if there's a huge recession and Amazon shares go down 50% because Amazon's revenues and cash flows go down, that doesn't necessarily mean that you're going to derive less value from downloading music or watching movies or getting Whole Foods discounts and all the other perks that come with Amazon. What tokens do is they really combine those two. So instead of having these different stakeholders getting different value drivers, a token gives you both. Most tokens are designed to be both your Prime membership and your equity in one instrument. So take, for example, Ethereum. Right? Ethereum has real revenues and cash flows. If you think of Ethereum just as like an app store, the more apps that are built on Ethereum and the more transactions that happen, the more revenues and cash flows through fees are generated for Ethereum. And those revenues and fees go directly back to token holders. And as a result, part of Ethereum's value can be valued in the form of an equity, right? In the term of discounted cash flow on revenues and the profits of Ethereum. But also, Ethereum has this utility or benefit value, right? You can use ETH across DeFi as collateral to use different DeFi products. You can use Ethereum as the gas or the currency of any of the apps and the ecosystems within Ethereum. As a result, there is a utility value to Ethereum as well, right? More of this kind of rewards, loyalty, a value that's different. So ultimately, when you go back to like, why will you see a divergence of digital assets from debt and equity this year? It's because we probably are heading into a recession. We are going to see lower cash flows, lower revenues, which is going to negatively impact both equities and debt. But those same drivers are only going to partially impact digital assets, but the utility value, this usage value, will only continue as you see more and more companies and projects getting involved in this space. So I do think digital assets will likely prove to be more recession-proof than equities if we have a downturn. And I also think they will prove to be a higher growth asset to the upside if you see a return to growth. And either way, I think digital assets are going to perform better than debt and equities in 2023, and also, like I said, ultimately decouple and have very little impact on what's happening with the Fed or central banks or everything that really drove returns in 2022.